Commodity overview and price action. Crude oil futures are experiencing strong upside volatility, with West Texas Intermediate trading near $91.45 per barrel and Brent crude breaking through the key $100 per barrel milestone. While broader equity benchmarks remain sensitive to macroeconomic data, energy markets are factoring in a substantial geopolitical risk premium alongside sharp draws in global crude inventories. Recent shipping slowdowns across critical maritime choke points like the Strait of Hormuz have tightened prompt physical supply, forcing commercial refiners to bid up available spot cargoes. This price action reflects an environment where physical supply tightness intersects directly with seasonal demand, creating immediate pricing power for upstream U.S. energy producers. Macro drivers and central bank forces. To evaluate the macro picture for oil, we must examine foreign exchange momentum and central bank inflation targets. When crude oil prices surge, energy inputs immediately feed into headline consumer price index prints, complicating the Federal Reserve's path toward interest rate normalization. Simultaneously, the US dollar index, DXY, plays a critical role, with the index trading near 101.40. Currency consolidation continues to support dollar-denominated physical crude demand from international refiners. Furthermore, with Strategic Petroleum Reserve (SPR) levels sitting well below historic multi-decade averages, sovereign policy options to suppress oil spikes via emergency supply releases remain structurally constrained. Structural supply and demand dynamics. Turning to fundamental supply dynamics, OPEC+ continues to maintain strict production discipline, effectively controlling global spare capacity to enforce a high pricing floor. In North America, U.S. shale operators in the Permian Basin are prioritizing capital discipline and shareholder returns over aggressive volume growth. Rather than surging production to flood the market, top exploration companies are keeping reinvestment rates disciplined, capping domestic production expansion. At the same time, global refinery crack spreads, the margin between raw crude input and finished fuels like diesel and gasoline, remain elevated, indicating strong physical processing demand across global refining hubs. High-impact USA stock winners. For U.S. equity investors, crude oil trading above $90 per barrel generates exceptional free cash flow yields for integrated energy majors. The premier upstream leader in the U.S. market is ExxonMobil, NYSE, XOM, with low break-even extraction costs and massive refining scale. Every $10 expansion in crude pricing generates billions in additional operational cash flow, backing share buybacks and dividend growth. Our second key energy winner is Chevron Corporation, NYSE, CVX. Chevron boasts a fortress balance sheet and top-tier asset positioning in the Permian Basin, allowing the company to capture immediate margin expansion during crude rallies without incurring heavy capital expenditure burdens. For broad sector exposure across upstream producers and oilfield services, the Energy Select Sector SPDR Fund, NYSE, XLE, offers a high-yielding, liquid vehicle to play broad energy equity momentum. Squeezed USA stock losers. While energy producers benefit from high crude pricing, sustained oil spikes act as an immediate cost burden on energy-intensive U.S. sectors. Commercial airlines represent the first wave of margin compression, as jet fuel accounts for roughly 30% of total operating expenses, eating directly into quarterly operating margins when ticket prices cannot offset fuel spikes. The second major sector facing margin pressure includes global freight, trucking, and logistics networks. High diesel prices increase transport costs across supply chains, compressing operating margins for transportation firms that lack dynamic fuel surcharge pass-through mechanisms. Identifying these cost-sensitive sectors helps you manage downside risk when energy prices experience sustained upside breakouts. Forward look and technical roadmap. Looking at the technical chart roadmap for WTI crude futures, $86.50 serves as primary institutional support. To the upside, a technical breakout above $91.50 opens the pathway toward the target resistance zone between $95 and $100 per barrel. Over the coming week, market participants will monitor official AIA weekly petroleum status reports, U.S. inflation prints, and OPEC+ supply commentary. Maintain a balanced approach by using pullbacks towards support as potential entry zones for quality energy majors like ExxonMobil, XOM. To see how oil shocks tie directly into our daily coverage of the S&P 500, click the video on screen right now to watch our full US market breakdown. Subscribe to Global Macro Pulse, and we will see you in the next update.